Today's market action looked calm on the surface, but underneath it revealed something more important. Investors are beginning to weigh whether strong earnings can continue to offset rising inflation pressure, higher yields, and renewed geopolitical risk. The major indexes finished slightly higher, with the S&P 500 up just over 0.2%, the Nasdaq modestly positive, and the Dow barely changed. But this was not a broad risk-on rally. It was more of a holding pattern. Markets stayed near highs, yet conviction clearly softened as investors entered a week packed with Federal Reserve decisions, inflation data, and major tech earnings. The more meaningful moves happened elsewhere. Oil rose sharply, up more than 2%, as concerns around Middle East supply routes returned to focus. At the same time, Treasury yields moved higher. That combination matters because it can revive inflation fears, just as markets had been hoping for eventual policy easing. When oil rises and yields rise together, investors begin to question whether interest rates may need to stay elevated longer than expected. And that helps explain why stocks advanced only cautiously. Gold fell, Bitcoin slipped, even traditional hedges did not attract strong demand. Volatility also eased, with the VIX moving lower. So despite a growing list of macro risks, markets are still behaving with a notable degree of calm. That calm may be confidence, or it may be complacency. Under the surface, capital flows were selective. Technology still attracted buyers, and financials led the market. That suggests institutions continue favoring areas with earnings power, scale, and resilience. In tech, the focus remains the AI theme. In financials, higher for longer rates can still support profitability. Meanwhile, money moved away from real estate, consumer staples, healthcare, and consumer discretionary. That tells us something important. Investors are not fully defensive, but they are avoiding sectors most sensitive to rates, weaker consumer spending, or slower growth. In other words, confidence remains concentrated, not broad. This week's earnings calendar helps explain that concentration. Microsoft, Meta, Apple, Amazon, and Alphabet all report soon. These companies are not just large corporations anymore, they're effectively market leadership itself. Their results will shape sentiment around cloud demand, advertising trends, enterprise spending, margins, and most importantly, whether AI investment is generating real returns. One open question investors are debating right now is whether this market strength is durable or simply dependent on a handful of mega-cap names continuing to outperform. I'd be curious how you see that risk developing. Feel free to share your view in the comments. There are also hidden vulnerabilities building beneath the surface. First, narrow leadership risk. If too much of the index depends on a small group of names, disappointment can travel quickly. Second, the oil plus yield combination. Higher energy costs can pressure margins, while higher yields reduce valuation support. Third, real estate weakness remains a warning sign. Financing-sensitive sectors often react early when rates become restrictive. And finally, low volatility ahead of a Fed meeting and inflation data may signal that markets are underpricing potential surprises. So what is the broader macro signal? Today did not look like a full regime change. It looked more like a pause in the bullish narrative. Markets are balancing two competing forces. On one side, strong corporate earnings and continued belief in AI-led growth. On the other, inflation pressure, elevated rates, and geopolitical supply risk. So far, investors still trust profits more than they fear macro drag. But if yields continue climbing, that balance can shift quickly. The next major tests are clear: mega-cap earnings, the Federal Reserve's statement, inflation data, and developments in energy markets. Each of these could reshape expectations around growth, policy, and valuation. What this suggests for investors is that the market remains resilient, but increasingly dependent on execution rather than optimism alone. If you enjoy this type of calm, analytical breakdown of global markets, consider subscribing. I publish regular briefings focused on the deeper forces shaping market behavior. Thank you for spending a few minutes here today. I appreciate you being part of the channel.